Have you noticed something? You're 18 to 24. You might even be earning money, but you still haven't started investing. Every time it's the same excuses. I don't have enough money. It's too risky. I'll start when I understand it better. Now isn't the right time. And then a year goes by. Here's the truth. The problem isn't money. The problem is you don't have a simple starting plan. In this video, I'm going to show you how to realistically start with just $10, which US market funds beginners are using right now, and how to avoid the mistake that people at 30. If investing is so powerful, why don't most young Americans actually do it? Surveys show a large percentage of 18 to 24-year-olds either don't invest at all or only try trending stocks and crypto. Why? Because they believe you need $1,000 plus to start. The market is too complicated, one wrong move, and your money disappears. But here's what's changed. In the US, you can buy fractional shares. That means if a stock costs $300, you can invest just $10 into it. The real issue isn't money, it's lack of strategy. Pay attention to this part. Most beginners don't actually invest, they guess. Someone on YouTube says this stock is the next big thing. Someone on TikTok says this crypto is going 5 times. And people throw money at it. That's not investing, that's chasing dopamine. Real investing is boring, and boring doesn't go viral, but boring builds wealth. If you're a beginner in the US, here's where people usually start. First, S&P 500 index funds. Second, Nasdaq 100 based ETFs. Third, total US market funds. Fourth, international market funds. Fifth, high yield savings. Let's understand it step by step. 1. S&P 500 index. This index represents 500 of the largest companies in the US. Historically, over the long term, it has averaged around 8 to 10% annual return. It's not guaranteed, but the long-term trend has been upward. Beginners like it because diversified simple. You're investing in the overall US economy, not just a single company. 2. Nasdaq 100 based ETFs. This index focuses mainly on major tech companies. During certain periods, it has delivered higher growth than the broader market. But it's also more volatile. Higher upside potential, higher downside risk. 3. Total US market fund. These funds include large, mid, and small companies across the entire US market. More diversification, often chosen by people who want broad exposure without picking stocks. Or international market funds. Instead of only investing in the US, these funds provide exposure to global markets. Different regions perform differently depending on economic cycles. This helps spread country-level risk. 5. High-yield savings accounts. If you need your money in 1 to 2 years, investing might not be the best option. High-yield savings accounts in the US have offered better interest than traditional banks in recent years. Not designed for huge growth, designed for stability. Important? None of these options guarantee returns. Markets go up and down. What matters most is your time horizon and discipline. Here's the uncomfortable truth. Young investors usually make one of 2 extreme mistakes. They either never invest at all, or they go all in trying to get rich fast. There's no middle ground. They say, I'll just stay safe and not invest. Or, let's go big, high risk, fast money. Both are emotional decisions. Smart investing isn't aggressive, it's consistent. A simple beginner framework. If I were 18 to 24 in the US starting today, here's the framework I'd follow. Step 1. Build a $500 to $1,000 emergency fund. Step 2. Open a simple brokerage account. Step 3. Invest a fixed small amount, weekly or monthly. Step 4. Don't panic during market drops. Step 5. Increase contributions as income grows. That's it. No hype, no predictions, no next 10 times secret, just discipline. Now imagine you're 30 and you realize if I had just started at 20, the difference wouldn't come from luck, it would come from time. And if you're 16 to 24 watching this right now, time is your biggest unfair advantage. Not money, time. Today you learned why most young people don't start, where beginners in the US typically invest, the emotional mistakes that cost years, and a simple strategy that actually works. If you want the next video, I'll break down how to build your first $1,000 emergency fund in the US, step by step. Comment, start now. If you're done waiting, fast money is exciting. Slow money changes your life. And if you've made it this far, you might as well subscribe to the channel. I'll see you right here in the next one. Bye.